So
when do you anticipate the recession starting?
Usually 6 months to a year. Well, you can read the paper. You can read the paper. Last time is like the yield curve started to be inverted in October, and 2016 recession is a year later. But we don't feel like we're in a recession, right? But there are a lot of stores closed down, closed up. But I feel Jacksonville is still booming. You see lots of constructions going on. Yeah. So why? Fed increase the short-term interest rate, and the long-term interest rate should go up with it too, right? But that's not control. Fed cannot control 30-year interest rate. Fed can only control the short-term interest rate. So why the long-term interest rate? If long-term interest rate goes up with the short-term, then that's not a problem. It's a normal yield curve. Why it's not? So what do you guys think? Well, you can think about it, and maybe I put yeah, I'm asking you to draw the yield curve. This is, you will get the inverted yield curve too. You see 2 years, 3 year, 5 year are, 3 years is higher than 5 years. So, yeah.
When you try and do it in Excel,
Yeah.
you have to use the same units. So if you do months and years, it won't work. So you have to do it all in months. And so it makes the curve, you can still see a little bit of inversion, but it doesn't look like that.
Well, this, yeah, I got this one. I guess this is just the way they do that, even though, you know, if you think it's 1 month, it shouldn't be like that. This is 2 months period, that's 3 years, it's not in the right scale.
Right.
Yeah.
So I'm just, if it looks a little different, but it's using the same numbers, that's...
Yeah. Well, but you should try to make it like this, because I guess this is just the right way to show the yield curve. Yeah, because you click on this so you can find, I just got it from here, the yield curve, this one.
Right.
Yeah, this one. See, this is how they report the yield curve. These are the numbers. Yeah, try to just make it like this.
Okay.
Yeah. All right. Okay, so why? So you guys know what's yield curve, and usually the long term should be higher than the short term interest rate. But why? Why long term has to be higher than the short term interest rate?
Because that firm wants to hold on to your money and invest it.
Well,
So they want to keep it for longer.
they want to keep it too longer, but for you, if you want to lend the money to somebody for a long period, you want more return, right? Because it's risky. Yeah. So you see, we're jumping around, but let me just show you. You know, we can break down the interest rate like into like several components here. So if you want to lend to others for a longer period, so you have to consider like. Is the person will default on your money or not? And when you need the money, can you get it back very quickly? That's called liquidity. And if it's longer, and you have to sacrifice, like you cannot use the money for a longer period, so there's a maturity risk in it. So that's why like you have to wait for a longer period. All these part will be more riskier. So you have to add more to like the returns you want back from your investment if it's longer. But we'll cover it later. But anyhow, let's still go back to this question I'm asking you guys. So when Fed increased the interest rate for short term, why the long term interest rate don't go up with it? If we go up with it, then we don't have this worrying for a recession. So based on the professionals' predictions, so we might have another recession by the end of this year. So what do you think? So why long term? This one, if it goes up, like the blue color one, so it's no one will be worrying. Economy, people are still like want to invest more in the stock market. Now you might want to rebalance your portfolio and put the money, some of the money investment into a safer security, like what? Now, when Fed increase interest rate, you worried about the future of the economy. So what you would do? Are you going to pull out your money from the stock market? And where you want to put it? Into which one is the safest investment? Treasury security, right? Treasury security, you may want to put it for like, you're worrying for the market will be so risky. So you want to take your money out of the stock market, put it into the treasury security for example, for 10 years or 30 years, treasury security, right? So that this is the safest investment is to put the money in the treasury security because government will never default and US dollar is strong. So you put the money into 10-year, for example, treasury security or 30-year treasury security, right? So from the stock market. So you buy 10-year, 30-year treasury security. So what will happen to those treasury securities? Goes up, price go up, right? So demand for these, when economy is turning, it's going to be bad, and the demand for long-term treasury securities will be increased, it will be high. So what's the result of that? Demand for these treasury securities will be high, and what's the result? Price will be high, right? Price will be high, and the yield will be what? Yield will be low because they move opposite direction. So yield will be low. So the worse the economy is, the lower the yield of these long-term treasury security. So it will just make it even more like inverted. So instead of like going up to become normal, because the demand is so high, price for these will be high, and yield will be lower. So you see these numbers will keep on dropping. So, but the short term is controlled by Fed. But you see 5 years, 10 years, 30 years, 7 years, 20 years, treasury securities returns will continue falling, dropping, falling. So to make this even more inversed. Yeah, so you see it's all makes sense? So this is one of the explanations for that. It's just like, well, the people feel recession is coming, so you pull out your money from stock market and invest somewhere where invested in treasury securities for those long period. And demand will be high for these, price will be high for these, so yield of these securities will be lower. Yield will be lower, and reflected in this yield curve is getting more inversed. And because companies couldn't get the money from the stock market, and their business is going to be not as good as before. So it's a cycle of like seems like recession cycle. Just like companies don't have the way to raise capital anymore because people are not interested in the stock market, so they pull back their investment. So they slow down their growing, and then and people start to worrying, this. So that's why now you see inverted. It could be even more inverted in the future. If people do feel panic, so right. Yeah, so we wanted to going back to normal, but the Fed has to, for example, to reduce interest rate. So what is the Fed policy or anticipations for Fed monetary policy for this year, 2019? Keep on raising interest rate, or reducing the interest rate, or just hold it at this level? I think the recent one activities of Fed is just not to raise interest rate, just keep it at this level. But Fed cannot reduce interest rate. Reduce interest rate is to do what? To reduce interest rate is just to that's the way Fed is dealing with recession. But we're not in recession, so it's not the time to reduce interest rate. So what the Fed is doing is just to keep it at this rate, not continue increasing the interest rate. If Fed continues interest rate, you see the short term still going up, the market will be more panic, and it will be falling even more than that. So this is, that's why from the yield curve, we can tell so many informations. Right? Yeah, let's watch a couple of videos, and then we will do the breakdown of the interest rate, and then we'll do the case study. But you see, it's very informative for the yield curve. Right? Any questions? So you see here, there are different shapes of yield curve. And so it has a date here, January 2006. This is still normal yield curve. Short term is low, long term is higher than short term. And now this is normal economy. Most of the time yield curve is like this. And steep yield curve, this is like a year ago. Short term is very low. Fed purposely reduced to keep this interest rate low to boost to make the economy booming. So this is a steep yield curve to help the economy to grow fast. So this is steep. This, if you see the sign of this one, an economy is doing very well. So it's over. It's more than expected. So it's growing too fast, maybe. So inverted like today, and recession is coming. If Fed continue raising interest rate, we may see this happening. So this is February 27th, 2007. So we're not that bad yet, but this is this yield curve is telling you something about the future economy. Flat or humped curve. This is July 2006. This is more like ours current yield curve. So it's not a good sign. The good sign is normal. This one is a normal one. And the economy is improving, steep curve. It could be it's not going to last too long. For interest rate shouldn't stay so low for too long. So this is a steep yield curve. Okay. So do you have any questions? Yeah, let's watch a video here. You can find the information at finra.org. You can find daily interest rate at marketwatch.com here, or go to treasury.gov. You can find it. Now let's watch the Khan Academy's video about yield curve, and let's start from here.
If you were to borrow money for different amounts of time, you can imagine the person lending you the money might charge you a different annual interest rate depending on the perceived risk of having the money out there for that amount of time. And the same thing is true when people lend money to the federal government. So when you think about U.S. Treasuries, and U.S. Treasuries that have different maturity, maturity just means when is the government going to pay you back. You can imagine that there are different interest rates, or there's different yields to maturity on that debt. So if we were to plot it, so let's say that, and I'm just going to simplify here, let's say that there's some treasury debt that's maturing in 1 month. And if you look at the price that you would have to pay for that debt versus the amount of money that the treasury is going to pay you when it matures, you see that the yield there is, let's say it is 1%. Let's say for treasuries that are maturing in 3 months, the yield is 1.5%. Let's say the treasuries that are maturing in, I'll just pick some maturity dates here. Let's say in 1 year, the yield is 3%. 3%. Let's do a couple more. Let's say in 10 years, so if you were to literally, you're essentially lending money to the Treasury for 10 years now, the annual interest rate on that, let's say it's, I don't know, let's say it's 3.5%. Let's throw one more up here. Let's say if you were to lend money to the US government for 30 years, the yield is running at, let's say it's 4%. So here we have different yields for different maturities. And if we essentially plot this on a graph, we get ourselves a yield curve. And it's usually called the yield curve. When people talk about the yield curve, they're talking about the plot for the US Treasury in dollars, US Treasury bills and bonds. You can have a yield curve really for any debt instrument, for any corporate bonds, or even government securities or corporate securities of other countries. But in general, when they talk about the yield curve, they're talking about US Treasuries. So let me draw a yield curve right over here. So on this axis, I will put maturity. Let me scroll down a little bit. So maturity. And we have a bunch of different maturities. We have 1 month. Let's squeeze it. 1 month. We have 3 months. And this won't be completely to scale. Then we have 1 year. Actually, 1 month and 3 months. Let's just put 1 month right at the beginning. So 1 month, then 3 months is a little bit further out. 1 year would be right over here. 1 year. 5 years would be like there. 5 years. I don't have a 5 years. Let's do 10 years. So I'll extend my line over. So 1 year, maybe 10 years is over here. 10 years. And then you have 30 years. And I'll just draw 30 years as far as I can. It's not completely to scale, but it's my best shot. And then we plot the yield for those different maturities. So in 1 month, you have a 1% yield. So let me do it with percentages here. So this is 1%, 2%, 3%, 4%. So on 1 month maturity, the yield is 1%. On 3 month maturity, the yield is 1.5%. So maybe it'll be like right over there. On 1 year maturity, the yield is 3%. So you plot 1 year, this is 3%, let me write it. So this is 3% right over here. This is 1.5% right over there. The first one right over there is 1%. And then at 10 years, it's 3.5%. So 3.5 is right over here. We want that to be 10 years. I'm just plotting that point. And then at 30 years, it's 4%. So 4% is what we get at 30 years. And if we connect the dots and draw a curve, we are giving ourselves the yield curve. We are giving ourselves the yield curve that normally, well, I don't want to make it look like, let me see how well I can draw it. You have a curve that might look something like that. And just by looking at this yield curve, you see that when you lend money to the Treasury for a longer period of time, you're going to get a higher interest than you would for a shorter period of time.
Yeah, so, okay. This is yield curve. So this is information I got from Bloomberg today. This is the most recent one. So you see, this is the price, 2.4. The yield is 2.44% annual interest rate, and okay, the price is 2.4. It looks weird, right? Anyhow, I'll go back and check what this price means here. So anybody else can help me? 2.4 for the price. Price should be around 100, because for bond should be around 100. 2.4. 2.44. There's no coupon. That's right, because it's matured for 3 months. This is the name symbol for this Treasury security. These are all symbols for the Treasury security. The price is, the 2.44 is your annual return. So you see, annual return for 3 months Treasury bill is 2.44%, but for 6 months Treasury bill is 2.51%. Is even higher than 12 months Treasury 2 year. This is 2 year. 2 year Treasury note return. So 2 year Treasury note return is higher than 5 year Treasury note return. So that's not right. So it should be continue going up. The next one with longer maturity yield should be higher. But in this case, it's definitely messed up somewhere. But the price, I need to figure out what this price means, 2.4. So anybody else know, familiar with Treasury security? Price is 2.4, it should be around 100. So can somebody help me? Should be around 100. So the price should be how much? We can calculate the price should be how much, because we know the yield, so we should know the price. So remember the bond should be $1,000, and the return is 2.44%. But this is 3 months. 3 months, the interest rate should be 3/12. So that should be your price for this bond. So bond should give you 2.44 return. How much it is selling for? It should be 1,000 divided by 1 plus 2.44% times 3/12. So it should be 993.937. And it's reported should be 99.3937. So that should be the price. But why it says 2.4? So this number should be 99.39, not 2.4. I don't know, it's a typo, but it shouldn't be because it's a Bloomberg. Can somebody help me? Because you know, you're making 2.44 return in the whole year, but it's only, you hold it for only 3 months. So your yield should be 2.44 multiplied 3 divided by 12. In 3 months period, this is your return. So each bond is $1,000. So how much you should pay for this bond? You should pay $993.937 to make this 2.44 return in a year, but you only hold it for 3 months.
So the 2.44 times 3/12
percent.
yield.
Yeah, that's a yield. Yes, yeah.
And then from there, we just calculate the.
You use 1,000. Your 1,000 is like you will get $1,000, but you just pay. You pay. It's just like you lend to the government $993.94 to the government. You get $1,000 back in 3 months. So your return will be 2.44% multiplied by 3/12. But I don't know what this 2.4 means. I didn't pay attention. So this price should be 99.39 instead of 2.4. I don't know. Maybe you guys can help me.
How frequent are the coupon payments on the?
Coupon payment is 0 because these are matured in 3 months. You see, so there's no coupon. Coupon is only for like a treasury securities longer than a year. You receive coupon. But you don't pay $1,000 to them. You pay less than $1,000, but there's no coupon. But you get $1,000 back. You lend them less than 1,000, but you get $1,000. So that to make sure you're making some return. Yeah, so I'm asking you to draw the yield curve. Since we did the exercise, we don't have to do that, but you guys know what it is. You see, so you can go over here to get the daily yield. Daily yield. Interest rate is changing every day. That's a surprise to you? So you see, this is 1 month, 2 months, 30 years. The yield. This is all these numbers are yield. You should add the percentage. And so yield is changing every day. So I got it from March 1st to yesterday's. So March 1st, 3.13% for 30 year. Now it's 3.01%. So what's going on? Why it's changing every day? Fed has done nothing because once Fed had a meeting, they make the announcement. We all know that because it's public information. They just meet 7 times a year regularly. So it's not Fed. So why? So you see the yield is keep on dropping for long term. For short term, it's about the same. but for the long term, it's going down, especially for 30 years, also for 20 years. Also, you see the tendency of falling for 10 years, and even for 5 years. So why? So that's my question, why? So that from here, what you can tell, well, you know that the yield is falling because of what? How it's a price. Price is going up and down. Yield is falling because the price is going up. Yield and price move opposite direction. So bond price, 30-year Treasury bond, 20-year Treasury bond, price has gone up. Price gone up because of what? Demand is high or low? Demand has been increasing or decreasing? Demand has been decreasing, that's why price go up. So why demand is decreasing? They're increasing for 30-year bond. Because they consider it's very attractive, it's safe, right? So it's just telling you like more investors are investing in those long-term treasury securities. So demand increases, price increases, so yield falls. So it just, the activities like this will just make these yield curves more inverted. If it's continue falling, so the gap between long-term and short-term will be even narrower. So it's definitely the economy is showing some sign of like it's not as good as before. Yeah. So so you can find the interest rate, daily government interest rate from this website here. So short term is controlled by the Fed. But if investors want to put the money in somewhere safe, they will put the long-term treasury security and long-term also. Because for short term, when it's time is coming and you have to take it out and you have to resave it, but redeposit. But for long term, you can just leave it there for a long time. So if you want some security, you want some place safe for your money, and that's treasury securities. Right? Treasury security. Okay. So from here, you know, long term for treasury security, long term anyhow, even though it's inverted, 30 years is still higher than a year's. A year is like 2.55, 30 years is 3.13. So why is that? We can break down the interest rate into these kind of, so this is how we break down the interest rate. So what this R star means, so usually it has 1, 2, 3, 4, 5 components for each interest rate, including your student loan rate, credit card rate, mortgage rate. You can all break it down into these 5 parts. R is a real interest rate. It's related, for example, if you have $100 and you can buy, it's related to like real purchasing powers with the money. So, for example, you have $100, you can buy a basket of things now, but if you put in a bank and you take it out a year later, you can buy more stuff. And that difference is called real interest rate. It's just like you increase your purchasing power by keeping your money in the bank. That's real interest rate. That's like not related. You have to subtract the inflation, taking out the influence of inflation, and then that's real interest rate. It's just like real increase of your money when you think about how much stuff you can buy with the money. Any increase in the power of money of yours by depositing in a bank, you can buy more stuff, that's real interest rate. Like you save money in the bank and you take it out a year later, you can buy more stuff, and that means that's a real interest rate. It makes you better off. Okay, so the next item is IP, inflation premium. So we're assuming inflation should be like 2-3% every year for a normal economy. So there's always an inflation, and so you have to like add inflation. So just like price will go up every year by 2 to 3% every year. So you deposit money into the bank. You have to consider how much is inflation during this period, and then you add to like your real increases in the values of the money. That's real interest rate. These are the major component for everything, and then depending on the product of the investment, and you might have this default risk premium, DRP here. Default, like you invest in, for example, you lend the money to a risky business, your default risk premium should be high. But if you buy treasury securities, your default risk premium should be 0. So liquidity premium is also like you lend the money to your friend to a small business, your liquidity premium should be high because it's not tradable. But if it's treasury securities, liquidity premium should be 0 because many people want your treasury securities. And maturity risk premium is when you need more time for your investment, you add more premiums to that, because it just increases, it's more uncertain of your investment. So you add these up, so that should give you the real interest rate. That should give you the interest rate for that securities you're buying or the loans you're getting. So we can break it down into like 1, 2, 3, 4, 5 components here. So, and that explains why the long-term security should be higher, right? Is that right? Long-term, because 30 years treasury, it has the same real interest rate, it has the same real interest rate. 30 years, real interest rate is the same, and there's no default, there's no liquidity because both are treasury securities. But you got maturities, longer period, so you have maturity premium you have to add to that. Also, inflation could be high in the future, so long term should be higher than short term treasury security. So 30 years has to be higher than the short term, like 1 year. So also 5 years should be higher than the 2 years. Right? And then 5 years should be higher than the 1 years. Because you know, even though those are all treasury securities, there's no default, there's no liquidity, but there's still like inflation might be higher and maturity risk should be higher. So the longer you wait for your investment and the higher return it should be. So, right, so this is how you break it down.